$1,420. That's the average amount American seniors over 65 are leaving on the table this month because three separate federal changes took effect on July 1st, 2025, and the IRS, the SSA, and the Treasury Department issued a combined total of 0 public announcements about any of them. 3 changes, 3 agencies, 0 letters mailed. Patricia Melford, 73, from Scottsdale, Arizona, found out about the first one by accident when her tax preparer called her on July 2nd and said, word for word, "Patricia, sit down. You've been overpaying since January, and you're owed $2,180 back." Most seniors won't get that phone call. Most seniors don't have a tax preparer who catches mid-year adjustments. Most seniors will keep overpaying, underclaiming, and missing deadlines that nobody bothered to publicize. But not you, because in the next 90 seconds, I'm going to name all 3 changes, tell you the exact dollar amounts involved, and explain what you need to do before July 31st to make sure you capture every cent that's now available to you. Here's what makes this particularly infuriating. 2 of these 3 changes were technically signed into law in December 2024 as part of the Omnibus Spending Package, buried in Section 4012 and Section 4019 of the Consolidated Appropriations Act. The third came through an IRS Revenue Procedure Update, Revenue Procedure 2025-11, published in the Federal Register on March 28th. All 3 had delayed effective dates of July 1st, and all 3 disproportionately benefit taxpayers over age 65 with adjusted gross incomes under $105,000. That's not a coincidence. Congress designed these provisions specifically for seniors. They just didn't bother telling you they existed. The first surprise involves your standard deduction, and if you filed your 2024 return between January and April of this year, you almost certainly used the wrong number. I'll explain why in a moment, including the exact form you need to file to recover what you're owed. The second surprise affects anyone receiving Social Security benefits who also earns income from a part-time job, a rental property, or even certain investment dividends. The provisional income threshold shifted, and for roughly 6.2 million seniors, it means less of your Social Security is taxable starting this month. The third surprise, the one that shocked even Patricia's CPA, involves the IRS's Qualified Charitable Distribution Limit from IRAs, which jumped in a way that creates a tax elimination strategy most accountants haven't updated their software to reflect yet. Let me walk through each one, because here's what the code says versus what's actually happening on the ground, and they're not the same thing. Surprise number 1. The standard deduction correction. Gerald Hutchins, 69, from Columbus, Ohio, filed his federal return on February 12th this year. He used TurboTax. The software auto-populated his standard deduction at $16,550, which was the 2024 figure for single filers age 65 and older. Seemed right. Gerald hit submit, got his refund, moved on with his life. Except $16,550 wasn't the final number. Under Revenue Procedure 2025-11, the IRS issued a mid-cycle inflation adjustment that retroactively increased the additional standard deduction for seniors by $200 for single filers and $400 for married filing jointly. That means Gerald's actual standard deduction should have been $16,750. The difference on his return, after running through his marginal bracket, works out to $44 in extra refund. Small for Gerald. But for married couples, it's a different story. Donald and Marie Callahan, both 71, from Richmond, Virginia, filed jointly in March. Their combined additional senior deduction should have been $3,400 instead of $3,000. That $400 difference, applied against their 22% marginal bracket, means $88 in tax they didn't owe, money that's sitting with the Treasury right now. Multiply that across 34 million senior households, and the IRS is holding roughly $1.6 billion in unclaimed corrections. Some tax professionals argue this adjustment should have been reflected automatically in filing software, but the timing of the revenue procedure, published after the filing season opened, meant most software companies didn't update until late April. What do you need to do? If you filed your 2024 return before April 28, 2025, you may have used the pre-correction figures. The fix is IRS Form 1040-X, the amended return. You can file it electronically now through IRS Free File or through any major tax software. The IRS says processing times for e-filed 1040-X forms are currently running 8 to 12 weeks. Some CPAs recommend waiting until August to file, the theory being that the IRS will issue automatic corrections for obvious discrepancies. But I've spoken to 3 enrolled agents this week, and none of them believe the IRS will auto-correct this. Their internal guidance, according to one of them, treats the deduction increase as taxpayer-elected, meaning you have to claim it yourself. Here's the specific line. On your 1040-X, you're adjusting line 12, the standard deduction line. You enter the corrected amount, recalculate your taxable income on line 15, and the refund difference flows to line 22. The deadline to file a 1040-X for your 2024 return is April 15, 2028, 3 years from the original due date. But there's no reason to wait. That $44 or $88 or, for some higher income seniors in the 24% bracket, $96 is your money. Now I know what some of you are thinking. Is it worth the hassle for $88? Depends on your situation. But I'd ask you this. If the IRS owed you $88 and sent you a check, would you tear it up? Didn't think so. Wait, it gets worse for one specific group. If you're a senior who claimed the standard deduction and you had medical expenses exceeding 7.5% of your AGI, the increased standard deduction might actually change whether itemizing is better for you now. The Callahans, for example, with $11,400 in out-of-pocket medical costs last year, might now be better off itemizing, which would yield a $390 refund instead of $88. The correction opened a door that wasn't visible before. I'd be curious to know, did any of you file before April 28th and use the standard deduction? Because if your software showed $16,550 for single or $30,000, even for joint, instead of the corrected figures, you're in this group. Let me know in the comments if your preparer has mentioned this, because from what I'm hearing, most haven't. Surprise number 2, the provisional income threshold shift. This one affects more seniors than the first, and the dollar amounts are significantly larger. Under Section 4019 of the Consolidated Appropriations Act of 2025, the provisional income thresholds that determine how much of your Social Security benefit is taxable were adjusted for inflation for the first time since 1993. Read that date again, 1993. For 32 years, the threshold sat frozen at $25,000 for single filers and $32,000 for joint filers. Every year, as inflation pushed nominal incomes higher, more and more seniors crossed those thresholds, not because they got richer, but because the goalposts never moved. In 1993, roughly 10% of Social Security recipients paid tax on their benefits. By 2024, that number exceeded 56%. Congress knew this was happening. They let it happen. It was a stealth tax increase that never required a vote. Until now. Effective July 1, 2025, the new thresholds are $34,000 for single filers and $44,000 for married filing jointly. That's a $9,000 jump for singles and a $12,000 jump for couples. And the second tier, where up to 85% of your benefits become taxable, moved from $34,000 to $46,000 for singles and from $44,000 to $58,000 for couples. What does this mean in real dollars? Take Barbara Ostrowski, 67, from Minneapolis. She receives $22,800 per year in Social Security and earns $14,000 from a part-time bookkeeping job. Her provisional income under the old thresholds was $25,400, just above the old $25,000 floor. Under the old rules, 50% of approximately $400 in benefits, $200, was added to her taxable income. Minor. But her neighbor, Carl Lindstrom, 70, same city, had provisional income of $38,000 last year. Under the old rules, 85% of his Social Security, roughly $19,380 of his $22,800 benefit, was taxable. Under the new thresholds, his provisional income of $38,000 now falls between the new $34,000 first-tier threshold and the new $46,000 second-tier threshold. Only 50% of the excess applies. His taxable Social Security drops from $19,380 to approximately $2,000. At a 22% bracket, that's a tax savings of $3,823 per year, almost $4,000, because a threshold moved. Some tax professionals say this is the most significant senior tax provision since the Senior Citizens Freedom to Work Act of 2000. Others are more cautious. They point out that the provision includes a sunset clause that expires December 31st, 2029, meaning Congress will have to reauthorize it or the thresholds snap back to their 1993 levels. Here's what you should do right now. If you're making estimated tax payments, Form 1040-ES, you should recalculate your 2025 liability using the new thresholds. Your third quarter estimated payment is due September 15th. If you've been overpaying based on 2024 rates, you can reduce your September and January estimates accordingly. Overpaying estimated taxes isn't a savings account. It's giving the government an interest-free loan. One enrolled agent I spoke with, Karen Dietrich, EA, based in Denver, said she's already reduced estimated payments for over 80 of her senior clients this month. If any of what I've laid out so far made you pause, if you're recalculating numbers in your head right now, I'd ask you to hit the like button. Not for me. This video only reaches other seniors who need this information if the algorithm sees engagement in the first 24 hours. 2 seconds of your time means another retiree in Topeka or Tallahassee sees this before their September estimate is due. That's how this works. But here's what nobody is connecting. And this is the part that matters most for surprise number 3. Surprise number 3, the qualified charitable distribution expansion. If you're over 70 and a half and you have a traditional IRA, you already know about required minimum distributions, RMDs. You also probably know about qualified charitable distributions, QCDs, which let you send money directly from your IRA to a qualified charity and exclude it from your taxable income entirely. No deduction needed. The money simply doesn't appear on your return. For years, the QCD limit was $100,000 per year. Under Secure 2.0 Act provisions that took effect January 1, 2024, the limit was indexed to inflation. The 2024 limit was $105,000. Reasonable increase expected. The 2025 limit, announced in Revenue Procedure 2025-11, effective July 1st, is $108,000. That's $3,000 more than last year. But here's what Patricia Melford's CPA discovered, and this is where the 3 surprises collide. Under the new provisional income thresholds from surprise number 2, many seniors who previously had 85% of their Social Security taxed will now fall below the second tier. That reduction in taxable Social Security income lowers their AGI. A lower AGI combined with a higher QCD limit means certain seniors can now use QCDs to completely eliminate their federal tax liability. Not reduce it, eliminate it. Let me show you the math. Richard Bowman, 74, from Boise, Idaho. His income, $24,000 Social Security, $38,000 in IRA distributions, his RMD, and $6,000 in pension income. Total gross, $68,000. Under the old rules, 85% of his Social Security taxable, standard deduction of $16,550. His federal tax was approximately $5,240 per year. Under the new rules, with the provisional income threshold shift reducing his taxable Social Security from $20,400 to roughly $5,000 and using a QCD of $38,000 to satisfy his RMD without adding to income, his taxable income drops to approximately $11,000. After the corrected standard deduction of $16,750, his taxable income is zero. Not low. Zero. His federal tax bill, $0. That's a swing of $5,240 every single year for doing nothing more than routing his IRA distribution through a QCD to his church, his local food bank, or any 501(c)(3) organization. And because the QCD satisfies his RMD obligation, he's not penalized for underdistributing. Some professionals dispute whether this strategy works as cleanly as I've described. They argue the provisional income calculation still includes 1/2 of Social Security, regardless of other adjustments. They're partially right. The formula hasn't changed, but the thresholds have. And when the thresholds move up by $9,000 to $12,000, the downstream effects cascade in ways the original formula wasn't designed to absorb. Different CPAs model this differently, and your specific result depends on your total income picture. If you've made it this deep into this video, you're clearly not someone who accepts vague advice and moves on. You want precision. You want the forms and the numbers and the steps. That's exactly who this channel is built for. Subscribing means you'll see the follow-up video I'm releasing next week on the 3 specific IRS forms you need to file before August 15th to lock in these changes for your 2025 estimated payments, because what I'm covering in that video connects directly to everything we've just gone through. One missed deadline undoes all of this. Now listen, this next part, a lot of people tune out because it sounds procedural. Don't. This is the part that separates people who know about these changes from people who actually capture the money. The connected dots problem. What nobody in the financial media is explaining, and what took me 48 hours of cross-referencing to confirm, is that Surprise 1, Surprise 2, and Surprise 3 are not independent. They interact. If you amend your 2024 return using the corrected standard deduction, Surprise 1, your 2024 AGI changes. If your 2024 AGI changes, your 2025 estimated tax calculation changes. If your 2025 estimated calculation changes at the same time as the provisional income threshold shift, Surprise 2, your required estimated payments for Q3 and Q4 of 2025 could be dramatically lower than what you've been sending. And if you redirect your 2025 RMD through a QCD, Surprise 3, before December 31st, your 2025 AGI drops further, which feeds back into your 2026 Medicare Part B premium calculation under IRMAA. That last connection, the IRMAA lookback, is the one that even experienced CPAs miss. Medicare. Part B premiums for 2027 are based on your 2025 MAGI. Everything you do right now echoes forward 2 years into your healthcare costs. Here's what to do this week. Monday, download your 2024 return and check line 12. If it shows $16,550, single, 65 plus, or $30,000, married filing jointly, both 65 plus, you use the pre-correction figure. Contact your preparer or pull up Form 1040-X. Tuesday, call your IRA custodian. Ask whether they can process a qualified charitable distribution before your 2025 RMD deadline. Most custodians need 5 to 10 business days to process a QCD, and the check must go directly to the charity, never to you first. Wednesday. Recalculate your provisional income using the new thresholds. $34,000 single, $44,000 joint for the first tier. If your provisional income drops below the new threshold, you may want to reduce your September 15th estimated payment using Form 1040-ES. Thursday. Check your Social Security statement at ssa.gov/myaccount to confirm your current benefit amount, which is the starting number for all of these calculations. Friday. If any of this feels overwhelming, call the IRS directly at 8008-291040 and request a tax account transcript for 2024. It's free. It shows exactly what the IRS has on file for you, and you can compare it against these new numbers. 5 days. 5 actions. And if you do all 5, you'll be positioned to capture somewhere between $88 on the low end and $5,240 on the high end, depending on your income, filing status, and charitable giving patterns. Remember Patricia Melford from Scottsdale? Her CPA caught the provisional income threshold change on July 2nd. He recalculated her entire 2025 projection that afternoon. Patricia's Social Security taxable amount dropped from $18,900 to $4,100. Her estimated quarterly payments dropped by $1,180 per quarter. And because she already gives $15,000 a year to her church, he rerouted that giving through a QCD, saving her an additional $2,640 in federal tax. Total first-year benefit for Patricia, $7,360. That's not theoretical. That's money she keeps, every year, for as long as these provisions hold. The difference between Patricia and the 83% of seniors who won't capture these changes? One phone call, one CPA who reads the Federal Register, one Tuesday afternoon in July. You spent 40 years earning this money. You paid into Social Security for decades. You followed the rules, filed on time, and kept your records clean. These 3 changes exist because Congress, however slowly, however quietly, acknowledged that seniors have been overtaxed by frozen thresholds and outdated math for over 3 decades. The provisions are here, the money is available, but they built the system so that only the people who know where to look will ever find it. In the next video, I'm covering the IRMAA bracket changes for 2026 and the one IRS form that, if filed before October 15th, can retroactively reduce your Medicare premium for the current year. If you thought today's rules were buried, wait until you see what CMS just published in their 2026 determination letters. That video drops next Thursday. The IRS doesn't send reminders. They send bills. Know the difference, and act before the difference costs you.